Okay, this is Jesus' homework. Could you please, can anyone tell me what's wrong with this code? I think I have to blow up. Okay. Beg your pardon?
At the end of code,
Yes.
it will be code.
Okay. Yes. Anything else? Okay. Anything else? I mean, there is more fundamental for anything.
And last, he didn't ask for the answer.
Okay, actually there should be a okay. Anything else? I mean, there is more fundamental. So, do you think it is a code for currency corruption?
I think in this case, like D1 and D2 the same as the same way code and corruption.
Okay. So, just a moment. Okay. So my homework was about currency option. So the easiest thing you can do is first search Google. Okay. So let me try. Okay. Currency option. Okay. Okay. There is a formula. Okay. Yeah. So basically, all you have to do is just implement this mathematical equation in R or Excel in your case. Okay. So let's compare this formula with this one.
But the name of that model, wasn't it something Graham something?
Beg your pardon?
If you go to the internet website that you search, the name
Just
of the model, it seemed as if it wasn't Black Souls, Garment.
So basically, it is a Black-Scholes model. So let's read carefully. As in the Black-Scholes model for stock option, plain model for certain interest rate, the value for European option reference rate, typically calculated by assuming that the rate follows log normal process. Okay, extended Black-Scholes model to cope with the presence of two interest rates. So it is extended version of Black-Scholes model. But if you compare Black-Scholes model with this FX option, basically they are exactly same. Okay, exactly same except this part. Okay, RF part. In Black-Scholes model, RF part is simply dividend. Okay, in this case, it is a dividend on assets, so dividend on foreign currency is simply interest on the foreign currency, right? So in Jesus' case, Jesus' homework is simply Black-Scholes formula. Okay, it is not about currency option. And I explicitly told you to the currency because when my RA to the TA hour, okay, he explained R code with Black-Scholes formula. So simply doing homework with Black-Scholes formula is I cannot tell whether you copied his solution or not. Okay. That's why I asked you to do the currency option formula. So you know what's wrong with your code now?
Yes.
So your homework is not about currency option. It is simply Black-Scholes formula without dividend. I mean, it is Wikipedia and there are a lot of sources on the web, so I cannot understand why you, okay. Why is it difficult? Okay. Let me check another student's homework. Okay. Not everyone submitted homework. Let me check one of the homework. Okay. Okay, code PS. Okay. Web. Okay. So you have the same problem. Okay. So please be careful when you do the homework. Okay. So your homework is also about just simple Black-Scholes model without dividend. Okay. Basically, Black-Scholes model with dividend is equivalent, almost equivalent to the Black-Scholes model for currency option. Actually, currency option model. Black-Scholes formula for currency option is just a special case of the Black-Scholes model with dividend. Okay. You can just go over the web or go over any derivative book, and you can easily find it. How about Abdul's homework? Okay. Okay, Abdul, where is Abdul? Yes, where is your Excel file? Oh, you didn't do it. You can't do it, or you didn't do it. Okay. So, those who didn't submit homework, I'll give you 1 more week. Okay, so until next week, please do the homework. And if you believe you did the homework properly, please do it again. Jisoo and Wonhyuk also, right? Yes.
Sir, I did the homework without the Excel, but I was unable to upload.
Okay, so then please correct it and submit it again.
Thank you.
Oh, okay. Oh, you brought it today. Okay. Yeah. Then I'll give anyway 1 more week to every student. So please submit to this group. And for international students, now please use R instead of Excel. Okay. And if you have a question, ask Byung-Chul. Okay. I saw email exchanges about R code between Byung-Chul and some students, so please ask him, okay, to help you. And I have a homework until up to yes.
Anything like buy low, sell high.
There's well, you should be more specific at least. Okay, what should you buy and what should you sell at least, and when to buy and when to sell. Okay. So anyway, bring your investment idea in 1 sentence, and where is it? In 1 sentence, and with a motivating example. So you have to support your investment idea with some example. Basically you have to show that your idea is important and interesting problem to investors. One easy way to do it is to illustrate the importance of your idea with newspaper article or magazine article. So anyway, come up with the idea and do the Google search in the news. And if you can find an interesting article about your investment idea, just you can copy and paste it. Very easy, right?
Oh, so we don't need to create something, we can probably find something, copy paste it.
Yes, exactly. Very easy, right? Any question? Of course, if you want to summarize it, that would be better, but you don't have to. Just copy and paste. Bring up idea and copy and paste news article about the idea. Any question? No. Straightforward, right? And homework number 2, write R code for numerical integration and differentiation for an arbitrary univariate function. I developed this problem because some of you didn't learn calculus. Right? So the best way to learn calculus, differentiation and integration is actually to program the integration and differentiation with R based on the definition of them. Right? So what is the definition of differentiation? Again, you can do the Google search. The differentiation. You can do the homework with univariate function, so you don't have to do this one, right? Okay, you don't have to do this one. Just one variable function, single variable function, and the definition of the differentiation is simply okay. So when you write R code, for a given function, we need two input. We need input on X, input about H. Okay. So at the given point X, we wanna do the differentiation on the neighborhood of the H. Of course, when we make H small and small, very small, then it really converges to exact differentiation at that point. Okay. So it is the definition of differentiation, and simply all you have to do is just do the implement it with the R code. Second, integration. Integration is there are many types of integration. What I want you to do is to do the Riemann integration. This is the easiest integration. Okay, so Riemann integration is for given function, like let's say this is fx. Okay, and this is a. Let's say this is a and b. Okay, and Riemann integration of fx a b. Okay, is simply simply calculating this area. Okay, and one way to compute this area is like this. Okay. You set up rectangles, okay, in the area, like this. Okay, set up rectangle, something like this, and add the size of the area of this rectangle. Okay, and the smaller, the finer this rectangle is, okay, the more accurate the sum of this, the closer the sum of this rectangle is to the area of this one. Okay, so in the R code, what you have to do is first, given function of fx, you have to, of course, we need another two input a and b. Given a and b, what you have to do is first you have to segment. It is called actually partition. You will have to construct partition of this area. Okay, and then given point, it can be even left or right. It doesn't matter. At each point, you compute the value of fx. Value of fx is simply the height of this rectangle, right? And simply add them. If you need more question about the definition of Riemann integration, you can again do the Google. So Riemann integral. Yes. Okay. So Riemann integration is basically like this. So be rectangle finer and finer. okay, to approximate the region, the area, the size of area between the two points. Any question?
What's the function?
It can be any, it should be any function. So if I ask you to the integration of the sine function, sine x between 0 and pi, it should be good. It should be good. Okay, integration. If I give you some function like tangent x plus exponential x, something, any weird function, still you should be able to do the integration.
What homework do you use to find out?
Yes, so you can use any double function of yours, but if you wanna, if you ask you to try another function, then you should do the problem again. So what I want to do is basically for a given function, you cause integration. And if I modify the input function part with my arbitrary function, then the program should work also. So this integration function, the integration code, should not depend on the user-defined function, user-provided function. It should be independent of the user-provided function. You should do the integration for any user-provided function. Any question?
What is the minimum error?
What?
Minimum error.
Minimum error?
Yeah.
So I mean, I don't want a fancy code. So you don't have to calculate minimum error, okay? But I want you to be able to control the error by changing the size of the rectangle in the integration, okay? So if you use a big rectangle, in this case, if you use a big rectangle like this, there are large error. If you use a small rectangle like this, then there is small error. So even though we cannot explicitly compute error in the integration, at least we can guess whether our error is big or small. So partition and integration, right? So Riemann sum. Basically, there is a function in the Wikipedia, so you can basically use this one to do the homework. And I'm pretty sure if we do this homework, now you master integration and differentiation. Okay. Any other question? Don't worry, it will be very easy once you start here. So it is a perfect homework, not only master calculus, but also R. To summarize, we have two new homework this week. One, investment idea with motivating example. Second, R code for calculus. And those who didn't do homework, last week homework, please submit it again. Okay, thank you. And about today's topic, for me, why don't you present your homework? Okay, while Bormid is setting up her presentation file, we need another volunteers. Actually, we need two volunteers for next homework, chapter 5 and chapter 6. Because chapter 5 and chapter 6 is kind of straightforward, we will do two presentations. Okay, what is your name?
Case.
Case. Okay. Okay. One more student. I need one more student for presentation. Okay, Juyeon. Juyeon is chapter 6. Case is chapter 5. Okay, thank you.
So chapter 6.
Yes, 6. Next week. Okay. Yes.
Okay, good morning everyone. Thanks for coming and waking up this early. Today we'll talk about basically mutual funds, about other investment funds. I'm sure all of you heard of these institutions before, especially in light of financial crisis, because they've been really involved into that. Right. These are the points that we'll be discussing today. What are the investment companies? Basically, what are their functions to investors? The types that are out there, and one of them will be actually mutual fund. It's a type of investment company, so we'll be looking more into details and what are their policies and how investors trade them. Also, being an investor, we have to look into the cost of investing into mutual funds. What are the fees? What are the other costs involved into that? And at last, there are some tips or some tips to basically match your expectations and what kind of mutual fund you should be going to. What is the investment company? Basically, it's a financial intermediary that collects funds from individual investors and from institutions and pulls them together. Once this money is pulled together, you have a big fund which you can invest into many different financial assets. Basically, it can be fixed, it can be equities, it can be indexes, and special sector funds. It ranges basically. So the function is basically pull, invest, and then redistribute the returns. These are the functions that investment companies execute for basically investors, right? They keep records and do administration work. Keeping records meaning they record all capital gains, all distributions, diversification and divisibility. Basically, having pulled all of that money from individual investors, funds have an opportunity to invest into different sectors, basically diversifying the whole portfolio that they are holding. Professional management. One of the main advantages, I think, of investing into investment companies is that they have professional management, meaning they have full-time security analysts who will be sitting down there and just trying to figure out the best portfolio for you, basically high yields if you want, or maybe secure if you want, depending on what kind of fund you'll be going for. And also another function that they execute is providing a lower transaction cost, because let's say if an individual wants to invest into some securities, basically each time we purchase we'll have to be paying a broker, right? But in this case of investing into investment companies, mutual funds and other funds, they basically will be dealing with certain brokers, and they'll be paying them fee, which when you buy in really big chunks will actually end up being so much smaller rather than paying individually. How do we basically value mutual funds? There's a ratio called net asset value, which is actually very similar to the price of the stock. You can find this ratio in the maybe finance sector of local newspaper. All right, so this NAV will be calculated every single day of the trading. So how do we calculate it every day? Is we take the market value of assets. Why do we take market value? Because the value of our portfolio, that we invested our funds in, will be changing every day, because it will be pool of numerous securities, and those securities will be changing like every minute, every second, right? So we'll have to be updating the market value of it. Basically, then you minus the liability and divide by the all outstanding shares. So it's very similar, like calculating ROE of normal corporation. All right, what are the types? Basically, there are two types, managed and unmanaged. And that actually means managed and unmanaged, because in unmanaged, there won't be a large management team that will be sitting down and managing all the portfolio, like every day, updating it, changing the diversification level maybe. So what they do is they buy securities at once, they set up a fixed portfolio, and they fix the life of this fund. So basically, you buy it and you sell it when the fund has expired already. Well, basically it will be dissolved. So there will be no everyday changing of the portfolio structure. What they issue to investors that invest into this unit investment trust is that redeemable trust certificates. Another feature of these investment trust funds would be that lack of management, as I said, so they will have actually lower management costs, lower fees. as compared to managed funds, which will be open-end and close-end. Open-end funds, they will be issuing the share to you, and you can actually redeem it back from the same people who will be setting up the fund, right? So at which price you will be paying and redeeming is NAV again. So this is the single ratio that investors should be looking at. And closed-end funds, they will issue, but you cannot basically go back and say, hey, can you take back my paper because I want to sell it. No, what you do is you go with this paper and you trade it on the exchange. Basically, they issue and it doesn't go back to them, but it keeps on trading on the exchanges. So open-end funds, they will be known as mutual funds. All right, so we'll look into that. What in US only, the mutual fund in 2009 accounted for 9 trillion each, which is enormous amount of money. It's like times of US GDP, right? And the biggest players you can see is Fidelity, Delaware, PIMCO, Vanguard. If you go and Google all of the open-end ones, top-rated, the top selling will always be funds traded by these companies. What are the types of funds that we have? Mutual funds. Basically, it's money market. In the portfolio, they'll have more of short-term securities. They'll also have equity. But in equity funds, they will also have a little bit of short-term securities in order for their liquidity, basically, if some investors will decide to quit. Also, some funds actually specialize in certain sectors. It will be like pharmaceutical or like biochemistry or something like that, something very specific. Another very popular type of funds will be bond. What kind of bonds? Municipal bonds, corporate bonds, all kind of bonds. So basically, it will be so much easier for security analysts to manage this kind of funds because they'll have to be just focusing on one kind of security. Also, there are international funds, balance funds, and index funds, or it's also known as ETF. What are the costs that investor can incur? These are operating front-end load, back-end load, which are both commissions, and 12B1 charges. Operating expenses, investors won't be paying specifically back to the fund, but these expenses will be automatically deducted from the asset value of the portfolio, and usually they range from 0.2 to 2% of the whole asset value. Front-end load commission is paid once you buy the shares of the mutual fund, right? But this is getting less and less popular. Market is more focusing on back-end loads, which is exit fee. Basically, when you're saying, okay, now I want to sell, I want to quit, you'll be giving back your share at the NAV price, but you'll have to pay this fee, which will range from 5 to 6%. Another charge, which is called 12B1, which corresponds to the Securities Commission rule, it's deducted from assets as well. You have to pay for distribution costs using these charges. When an investor has a choice between investing short-term or long-term, you'll have to think whether go for a front-end load or the 12B charges, because 12B charges is annual cost, whereas front-end is just one time. So if you're holding your portfolio, your funds for like longer period, it's better if you opt for a front-end, whereas 12B charges, it will be more for maybe short-term vision. How do we calculate the rate of return on mutual funds? Basically, NAV1, NAV0, these are the selling price and the price that you bought at, right? NAV1, that will be the latest price. NAV0, that's your investment cost, basically. Plus, you have to add the income, maybe distribution, dividends, depending on the type of the mutual fund that you invested to. You might be getting some, you might be not. And basically, you divide by your investment cost. All right, it's pretty straightforward, actually. And what kind of tradings there are? There are late trading and market timing. late trading meaning basically you don't trade while the market is open, like from what time? From 9 to 3 in Korea, right? But what you do, NAV has to be calculated every day, as I said. So basically when the market closes, they will recalculate the whole value of portfolio divided by number of shares, and they'll say, here you go, this is the NAV for today. So looking at it, you will see whether you want to buy it or not. This, however, contradicts the regulations, right? Basically meaning you have too much information and you can just do a lot of speculation. Another type is market timing. As for rapid in and out trading, how I can explain is that, for example, there's an investor in Japan and there are funds that are traded in States. Basically, the business hours of exchanges will be different due to time difference. So when Japanese market closes, US market opens, Japanese investor can actually buy those in US and sell it back in the morning in Japan. That's what's called timing. All right, the taxation advantages of mutual funds is that unlike corporate incomes that are taxed twice, right, it will be taxed only once at the investor level, meaning those people who establish funds, they won't have to pay any kind of taxation if they follow some requirements that are actually demanded by Securities Commission. So, but another disadvantage of this same taxation is that when your portfolio has really high turnover, you end up paying so much more. So that's why you have to balance. You don't have to go to two high turnover portfolios, then, because you know there will be different tiers, right, of taxing. There'll be lower, higher, and even like astronomical proportions. So the latest type of the mutual funds, as I said previously, the one was in the list was ETF, or is basically a mutual fund that lets investors to trade in indexes that can be matched to maybe Standard & Poor's or Dow Jones or Nasdaq, basically. So these transactions actually let you to hold index of all these different securities instead of just some kind of specific financial assets, which can be maybe equity or bond or special sector. There's a tax advantage of ETF as well over mutual funds because they're cheaper due to management fees again, right? So what are the tips what are the tips actually for investors when investing into mutual funds? Basically, you have to choose what kind of sector you want to go into. Second of all, you have to choose what kind of period, right? So, and also funds will tell you whether they want to invest into maybe high yield or lower yield, which will be more safer. And also, you have to look into the fees. Again, whether it's an annual fee or it's one-time fee. Based on that, basically investors can choose the fund that will suit them the best, all in all. So, try to make it short. Thank you. You guys have any questions?
There's a question.
Yes?
Yes, I have two questions.
Mm-hmm.
First, can you go back to the slide where it's fee structure? And it says front-end load and back-end load fees.
Yep.
Right? They take fees, right?
Mm-hmm.
When the shares are bought and when they sell shares, but like 5 or 6%, is it out of entire investment capital or
Of the NAV price, basically it's the share price of the mutual fund.
of the share price?
Yeah, of the share price.
So if the investor wants to profit, then he has to know that the profit rate is much more higher than 6%, right?
So that's basically you have to choose what kind of what kind of mutual funds you want to go into higher yield or lower yield, something. But you really definitely have to make sure that the price that you expecting in the future should be much higher than the cost that you will incur, meaning the fee plus the investment cost, NAV 0 that you
So when I
pay.
get my profit, the fees are all cut.
Yeah, the fee. No, this fee basically you'll be paying it. You'll be paying it based on the percentage of your NAV.
So it will lower your profit.
It will lower your profit definitely.
And next question is
Mhm.
about the last slide, an ETF. And it says, I asked what ETF stands for and
Electronic traded funds.
election trade.
Yeah.
And also, why do they have tax advantage?
They have tax advantage over the management fees because they'll end up being much lower rather than the mutual funds where you have to actually how to say managing your portfolio every time. So for that you'll have to be paying security analyst and everything. But for ETF, once you put it in the index, that's it. It just travels around. You just resell it, and so on.
Actually, that is true in United States, but in Korean market, ETF doesn't have that.
That's why. They said cost is reduced, but cost reduction doesn't mean tax advantage in my sense as well.
It has to do, I'm just reading it as well, it has to do with classification in the United States.
Because as I told, there will be different tiers, you know, like up to 10,000, maybe you have from 5 to 10, then it will be from 10 to 20. Depending on your income, your tax rate will be getting higher and higher usually. So as they're cheaper, meaning there'll be the profit margin that you get will be lower, and also the tax rate will be lower than the mutual funds one, where you get higher yields basically.
What about why is it different from United States and Korea?
It's political issues, I guess.
I mean, like,
You have to ask the authorities.
no, I mean, you said Korea doesn't have that advantage, but where United States is advantage through ETF. What's the difference? Just the system?
It's tax system, and usually in states they will be more investor friendly rather than in other countries. Will try I mean, you know, speculation, for example, in US is pretty much allowed, right? Whereas in other countries, especially in emerging markets, they won't be really letting that happen, so that it doesn't destabilize the market. Any other questions? Sir, questions from you? No? All right.
Thank you.
No problem.
If you want to invest in diversified portfolio, ETF is the easiest way. It is a bundle of stock or any asset, and it's traded in exchange as usual stock. So, for example, suppose you want to invest in Japanese market, then maybe you think that, okay, if I want to invest in Japanese market, I have to change won to yen, and I go to stock exchange and buy some stock there, something like that. But in reality, it is very easy to invest in Japanese stock. In Korea, there is ETF called Codex Japan. So it is a bundle of Japanese stock, basically portfolio of Japanese stock, and it is traded in Korea exchange. So if you are interested in Japanese market, you can simply buy Codex Japan or any other ETF based on Japanese stock, okay, for that purpose. I'm also investor in actually Japanese stock through ETF. So I bought Japanese the Codex Japan, the Japanese ETF for Japanese stock right after the earthquake, and then of course I made some profit there. So if you think there is still the fear in the Japanese market is overstated, it is best time to buy those assets. Any other question?
And as I know, there is a reverse ETF.
Yeah, there is also reverse ETF.
So
Yeah.
there's lots of options to.
Yes. There is a reverse ETF and there is also leveraged ETF. Reverse ETF means, so like for the S&P 500 ETF is basically fund of 500 stocks, biggest 500 stock in the United States. If we invest reverse ETF on S&P 500, whenever S&P 500 goes up, then the price of the ETF go down. So if S&P 500 goes up like 10%, your ETF, reverse ETF go down like minus 10%. So it moved exactly the opposite way. So actually I'm also a big fan of the reverse ETF. So when Korean stock, like 3 months ago, when Korean stock hit like 2050, I instantly bought reverse ETF and it went to like 1900 something and I made profit and I instantly changed my position to ordinary ETF. That's that. And there is also leveraged ETF, so it is a leveraged position. So whenever underwrite makes X%, it makes like 2 times of that or 3 times of that. So usual leveraged ETF is like two times of the return. So leveraged ETF about KOSPI 200 means whenever KOSPI 100 makes 10% return, your leveraged ETF will make 20% of the return. Of course, when KOSPI 200 makes minus 10%, your position will be minus 20%. Okay. So for example, I also invested in leveraged ETF when I was in the United States. So during the financial crisis, I bought leveraged ETF on financial institute. Because financial crisis, I thought there are after financial crisis, I believed that the stock price for financial institutions like Goldman Sachs or Bank of America goes down too much. So at the time I bought leveraged ETF on about financial firms in the United States. And of course, as you know, after financial crisis, those price of those financial institutions, the stock price for those financial institutions goes up very quickly. So I could make double profit out of it. Any other question?
I just wonder, do you have any loss when you invest?
Yes, I make a lot of loss sometimes. And actually, I am also long-term investor, kind of, especially when I invest in, not inverse ETF, when I invest in usual long-only ETF, I am kind of long investor, long-term investor, so I don't care short-term position.
Sir?
So I decided to be long-term investor of Japanese market nowadays. So I'll hold Japanese ETF, Codex Japan for at least 1 year. And yet, yeah.
During the financial market, I was just wondering why you bought the ETF when you could directly buy the shares of the investment firms.
Yes, I mean, so for example, yes, you are right. If I think, for example, I could buy like Goldman Sachs stock. That is possible. But problem is that Goldman Sachs has its own maybe risk. So of course, financial stocks may go together, but each firms are anyway different from each other. So they are affected not only by the sentiment about financial sector, but also about any firm-specific factors. And I don't want to be exposed to the firm-specific factors. Therefore, instead of buying individual assets, I bought ETF about entire sector. Yes.
What is your required year-to-year return on the long-term investments?
Me? I usually sell stock whenever I make 10%. Yes. And I also sell stock whenever I lose minus 10%. So they are like range. And whenever I hit their line, I make investment decision again. Yeah.
Is there any moments when you sold this stock at 10% and then later you found out it was higher? Do you ever have?
Yeah, that happened a lot. Yeah, a lot of times. Yeah. Yeah. Any other question? Okay. Let's review before the contract we learned last week. sorry, I have a pain in my neck, so I cannot speak loudly. Okay. Oh. Okay, about for the price, okay. Let me go over this part again. Yeah. So how to determine the forward price? When you enter forward price, basically there is no position. But at the end, if you are long position forward contract, then you will receive an asset. The value of the asset will be ST. Of course, you don't know what it will be at this moment, but then you reach the price of the underlying asset at T, and you have to pay X, the forward price. And to cover this question, what I just actually you sell the quantity today, and then you have to pay back the commodity at the end. In order to pay back the commodity at the end, you have to buy the commodity at the market price at T. Okay, so this is minus T. And if you add these two lines, of course, they cancel out. And in order, when you store commodity today, then you have cash by the amount of SG, this price. And simply you invest that cash to the bank, and at the end, the bank will give you this amount. So if you add that all, then basically this side is 0, so this side should be 0 as well. Therefore, for the price, it should be like that. Next. Okay, when there is a storage cost, when there is storage cost, of course, when, again, always everything is the same, when you enter the contract, basically, in this case, it is a reverse position. So when you sell the contract, but still there is no cash transaction today. But at the end, you will receive a forward price. Instead, you have to give the commodity underlying asset at the end to give other side underlying asset. You have to buy underlying asset at the market at the price of ST. Okay. So this is terminal cash flow from the contract itself. And in order to cover this position, what you have to do is you have to have an asset from today. So buy asset today, amount S0, but if you buy asset today, you have to pay today's asset price, which is S0. And then every period, you have to also pay storage cost. Okay? Cost of storing the asset, which is like S0, C0, C1, and CT minus 7, something like this. And then whenever there is a cost, basically you borrow money to pay this cost. So initial cost is, of course, acquisition price S0, and initial storage cost is C0. And you borrow the money by this amount, and you cover this position. Since you borrow this amount, you have to pay this amount back to the bank. And then other periods are same. Whenever you have to pay storage cost, you borrow the storage cost by the amount of storage cost, and at the end, you pay this amount back. You do you do this kind of transaction until the maturity. And if you add all the cash transactions, then it is 0 from today to T minus 1. They are all 0. Therefore, the cash flow at the terminal period should be 0 as well. If you add them all, it should be 0 as well. Therefore, you can solve F. F should be look like this. Let me write it down. So basically, F should be and if this storage cost accrues continuously, then of course we can change this as so basically this is same to and if there is continuous flow, okay, continuous flow, actually, okay, this is T. This is I. Something like this. And then if we use the exponential function, of course, this is right. Right? It is written like this. And if this storage cost occurs continuously, then of course this formula becomes so in this case storage cost occurs discretely. Right? In this case storage cost occurs continuously. We already run the definition of this exponential function, so we can easily transform from here to here. So this is a formula when there is a storage cost about underlying asset, right? But sometimes there is a benefit of holding underlying asset. If there is benefit of holding underlying asset, then maybe we want to subtract. Like this. So whenever there is a benefit, then suppose y is a benefit per period, then we have like this, and then of course we change this to ci minus y, right? And this continuous time rotation becomes s e r minus c. Actually, this is plus c. This plus c minus y. Looks like this. So to go over this formula, of course, when we have a higher spot price, the future price should be higher as well. That is very straightforward. Another interesting thing is when we have a high storage cost. When storage cost is high, then future or forward price becomes higher as well. So when it is supposed, actually when it is more expensive to store like 1 barrel of oil, for example, then it will increase this price, right? And it will increase the forward price, right? Can anyone tell me the intuition of why higher storage cost implies higher future price? So I already showed mathematically why it is so, but it is more important to know intuitively why high storage cost implies high.
Because forward price will include the future value of the cost that you're incurring.
Yes. So yeah, that's right. But more speaking more intuitively, basically, having forward contract is basically renting out underlying asset to the other party, right? So basically, anyway, there are two ways to holding an asset at the terminal period. One idea is to hold an asset from today. Another idea is to buy forward contract and hold nothing until time t and acquire the asset at time t, right? When it is expensive to hold underlying asset, basically in that case, people don't want to hold the asset anymore. Fewer and fewer people want to hold underlying asset. Instead, what people want to do is basically, instead of holding an asset, they will go to forward market and let other people hold the asset and pay the storage cost, and they simply get the underlying asset at the terminal period, right? So therefore, having a forward contract, they can save the storage cost in the up to the maturity until the terminal period. Therefore, when storage cost is higher, then people want to do that more and more, right? People don't want to hold underlying asset, and people want to hold futures and more. So there are more demand about futures, right? In some sense. Therefore, when storage cost is high, futures price or forward price go up. We can apply exactly the same logic about the benefit of holding an asset, this Y part. Okay, this part is called convenience yield. Okay, when we have a high convenience yield, it means we have a high benefit of holding an underlying asset. When we have a high benefit of holding underlying asset, then people want to hold more and more asset instead of having a futures contract, right? So there are less demand, fewer demand about the forward contract, and more demand about the underlying asset, right? Therefore, underlying the futures price should go down. In the Libya gets more serious. What's going to happen to the forward price? Can you tell me? Of course, if there is turmoil in the Libya, and Libya is oil producing country, therefore spot price should go up, oil price go up today, right? Since oil price goes up, future price go up as well. But my question is the other part. Besides the impact of the current oil price, how future price will respond because of the Libya crisis in Libya? Can you tell me? So forward price will be influenced by spot price, okay, convenience yield, and storage cost. Since my question is not about the impact of spot price, my question must be the impact about the storage cost and convenience yield. So basically, my question is about how the crisis in Libya will affect either storage cost or convenience yield, and eventually influence the forward price.
Well, given the turmoil, I think the trade level will decrease, meaning Libya will have to store all of the oil, crude oil that they explore.
Okay.
So as the trade will slow down, they will have to incur those costs. Maybe that will be another factor that will contribute to increasing forward price. Maybe.
So it will increase forward price.
Yeah.
Besides spot price. Okay. Any other comment?
Because as we can see, storage cost is in the denominator of the ratio.
Okay.
So it should increase.
Okay. Juyeon, how do you think? How do you think Libya crisis will affect either storage cost or convenience yield? Same as Berlin. Okay. You want?
Maybe it looks weird, but how about expectation for the spot price of oil? Because of the crisis, the oil price is expected raised, but it means the yield to keeping the oil is increased. So I think the Y factor will be increased and yeah, future price of oil will be slightly decreased.
Slightly decrease. Of course, it will increase this spot price, but may not increase as much as spot price. You mean? Okay.
I think that the yield and the risk will exceed a lot, so the I will be very high in the next year.
Okay.
My luxury.
Why should it be very high? Because of the media prices and will lower them. Okay. Any other thoughts?
But sir, those OPEC member states, they said that other countries like Saudi Arabia, they will increase the output of crude oil so that to balance off what Libya won't be giving. So in order not to make huge impact on the forward and spot prices of oil.
If that is the case, then of course, forward even spot price doesn't move. Should move. Well, actually, let us think more with more vivid example. So for international students, do you know the Hongdae Ikgu? Have you ever been to Hongdae Ikgu? Hongdae Ikgu, there are a lot of clubs around Hongdae Ikgu. You've been there, okay? So there are a lot of fancy clubs, and if you want to dance, you can go there and dance all night. So in the Hongdae Ikgu, there are a lot of clubs, right? Clubs. Okay. And suppose, actually, I'm too old to go these places now. They have age limit, so I can go, although I want to go. Actually. So anyway, suppose there is a Ford contract about Ferrari. Okay, Ferrari is a very nice car, right? Ferrari, am I right? Yeah, so it is very fancy car, right? Suppose there is Ford contract of a Ferrari, so, and then suppose there is Ford contract of Ferrari between me and my friend. So basically, I have a Ferrari today, and I have a Ford contract with my friend such that I give my Ferrari to my friends 1 year later, and 1 year later, my friend will give me like $1 million. It's too much. Anyway, $1 million, right? So it's a Ford contract. 1 year later, I'll give my Ferrari to my friend at $1 million. They take the Ford price. And what is the storage cost of this contract?
Depreciation of the car?
Depreciation of the car. Correct. Anything else?
The risk of damage.
Risk of damage and maintenance, of course. I think insurance. Insurance and everything, right? And basically, I have to park this car somewhere, right? So suppose I park my fancy Ferrari in Hanyang University, I have to pay money to Hanyang University, right? The parking fee, that is the storage cost. And there are other storage costs that are maintenance, those things. What is the benefit, convenience yield of having Ferrari?
Transportation.
Yeah, transportation, and I can go to Hongdae Ikgu Club and I can become a hot male, right? With Ferrari, right? So that's the convenience yield. So intuitively, right, when my one Hanyang University charged me higher parking fee, what's gonna happen? I don't want to hold the Ferrari anymore, right? And instead, I try to sell my Ferrari somewhere else. And maybe I prefer having a Ford contract. So if Hanyang University raise parking fee for Ferrari, of course, then it will increase. It will increase Ford price, right? Because people want to hold Ferrari less and less. On the other hand, if Ferrari become even hotter item in the clubs, right? So if Ferrari makes me even hotter male in club, in this case, convenience goes up, right? In that case, more and more want to have Ferrari to be a hot person in the club, right? It will lower basically Ford price, right? Because people want to hold Ford contract less, and instead they want to directly own this item to use it right now at the Hongdae Ikgu, right? At the clubs, right? Is it clear? right? Now suppose let's link this one in the Libya crisis. Suppose these Ferraris all comes from Libya now. Of course, that's a strange. Okay, let's find very example. So suppose all the Ferrari is imported from the United States, right? So it is Italy.
Is it?
Yeah, Italy, right? I should import this one from Italy. So suppose, so I should import this Ferrari from Italy, and suppose there is a crisis in Italy, right? Because of Berlusconi scandal or those things. Suppose there's crisis, and every year we can import 100 cars from Italy, 100 Ferrari from Italy, and because of crisis in Italy, now we can import only 50 Ferrari from Italy. What's going to happen?
Price will increase.
If Ferrari price increase, what else? What happened to the convenience yield and storage cost of the Ferrari?
You can be more hard.
Yes, exactly, right? I mean, even if there is a crisis in Italy, it doesn't change anything about how much Hanami will charge to the parking fee, right? But problem is that now there are shorter demand about Ferrari. Therefore, if I drive Ferrari to Hongdae Club, then I become a rare person, right? Rare male with rare item, so I can become even harder person, right? So that should increase convenience yield. Therefore, when there is crisis in Italy, therefore, the food price should go down because people want to hold more and more underlying assets. It is the same to oil, right? If there is a crisis in Libya, and it becomes serious and serious, basically convenience yield should go up because firms want to hold oil more and more to prevent possible disruption in their operation. Okay. So again, Libya, because of Libya crisis, current oil prices go up. If current oil prices go up, future prices should go up as well. But problem is that this forward price may not go as much as the current spot price because the Libya crisis will increase the convenience use a lot. Any question? Up to now, we learned forward and future contract. So shortly, we will learn how to generate excess return or how to develop portfolio strategy using in portfolio context. Okay, we will learn how to apply future and forward contract for portfolio management. But before doing that, we have to know about the portfolio. So I think you all know what is portfolio, right? Portfolio is basically bundle of assets. And when we have a portfolio, sometimes we want to change the relative weight in our portfolio. Sometimes we want to change the weight of individual asset in a portfolio, right? That's called portfolio rebalancing. There are many ways to the portfolio rebalancing. The most obvious one is buy and hold strategy. Buy and hold strategy is simply doing nothing, okay? So just hold the portfolio initial period and don't do anything until you liquidate the portfolio, right? That's simply buy and hold strategy. So one problem of this buy and hold strategy is that the better an asset performs in the past, the more portfolio weight it will receive. So it leads to a drifting portfolio mix. Right. So I mean, it is obvious. So even if you hold exactly same fraction of each asset in a portfolio, if one asset performs much better than the other, then if you don't do anything, the weight on those assets that has performed well will have a higher weight in the portfolio. So it is obvious. Which means that in the buy and hold strategy, if one asset performs better than others and some assets keep being dominated by others, then basically if you do the buy and hold strategy, your portfolio will be more and more biased to the well-performing assets. Therefore, that will make possibly in that case, you will possibly lose the benefit of diversification because some well-performing asset will dominate your entire portfolio. So there are several ways of rebalancing. One is calendar rebalancing. So the asset mix is rebalanced back to its policy benchmark at monthly, quarterly, or yearly. So periodically, portfolio managers review the portfolio weight, and some have far more weight than the allowed, and they will readjust the weight to the original benchmark level. And another one is range rebalancing. There are two approaches that can be used to keep the portfolio within a certain range of the benchmark at all times. Okay. First, rebalancing to the allowed range. So this assures that the asset mix does not depart from the extremes of the allowed range, but makes no attempt to return to benchmark at any time. So for example, yes? Okay, thank you. So for rebalancing to the allowed range, I feel like I'm in karaoke. That's weird. Anyway, yeah. So for example, consider 60% benchmark in an equity with 5 percentage points of tolerance, which means that this signals a sale of 1% when equity reaches 66% of the asset, right? So not going back to 60, but they just go to 65. Another one is threshold rebalancing. So this approach assigns much more weight to the wisdom of the original policy. So here, a move beyond the tolerance range dictates a return back fully to the policy benchmark. So in the previous hypothetical institution, with a 66% equity weight and 60% benchmark would reduce its equity commitment by 6% of the asset in the same situation. So instead of going back to 65, they go to 60. So it is threshold rebalancing. Next one is called the tactical rebalancing. So actually it is the maybe most popular rebalancing for active portfolio managers. So this enhancement to the rebalancing process simply recognizes that the optimal period or range to determine rebalancing events is not static. So in the previous rebalance, it is static, right? But now it is more dynamic. So it has the powerful ability to allow the portfolio mix to drift longer and farther from the benchmark during trending period, and to rebalance frequently and with tighter effective range during mean reverting times. So suppose a asset performed very well, and then that asset will have higher portfolio weight, right, in the portfolio. But if you think there is a trend, which means that well-performing stocks keep perform very well, and badly performing stocks will not perform very well in the future, then you are to allow your portfolio weight drift away from the benchmark. On the other hand, in the mean reverting period, such that past winner is likely to be loser, and past losers are likely to be winner, then you want to go back to benchmark very quickly. If some asset performed very well in the past, then by expecting, since you expect that that asset will not perform well in the future, so you want to reduce the weight quickly up to the benchmark. That's called the tactical rebalancing. So basically, you want to incorporate any information or any expectation you have to the portfolio management. Drifting mix, this is I already explained. So one might either purposefully or not choose to go with the flow. So it's basically doing nothing. So drifting with the market. The sponsor who adopts this non-strategy runs the risk of not meeting his fund's liability and ignore probable risk aversion of his committee. Right? So, some misunderstanding about fund manager is that sometimes we believe that fund managers can do anything they want about their portfolio, but it is not true. Usually, portfolio managers have a mandate which means that they have to abide by some rules. They have to abide by some rules of the portfolio. So they cannot do anything. Which means that they just cannot do anything they want. No, that's not true. Anyway, they have only allowed, they don't have full freedom in their portfolio management. So therefore, one could reasonably expect very long-term returns approaching those of equities. This would occur over several decades and the portfolio drifts further and further into equity. I'll give you an example. So for example, over the 50 years ending in December 1999, a portfolio which begins with 50% stock bond mix in 50 years ago, 1950, with stock dividends keep reinvested in equity and bond coupons reinvested in bond, would have drifted into 98% and 2% mix by December 1999, based on data. So even though your portfolio is balanced, balanced portfolio with 50% of stock and bond, this stock performs much better than bond in the past 50 years. Eventually, your portfolio, your fund is eventually dominated by stock. So it is not, you cannot enjoy diversification anymore because your stock is purely almost entirely equity. So accordingly, the drifting mix would have delivered return approaching equity, naturally, right? Because it is 98% equity. And the risk comparable to stock market risk. Yeah. So it may be very inappropriate given policy benchmark. The policy benchmark is 50% stock and bond. So it is the mandate of the portfolio. And this drifting is maybe not allowed. So this is an example. So portfolio rebalancing and so periodic rebalancing to compare periodic and wedge rebalancing. Okay, good. So annualized return looks like that, and drifting mix looks like that. So it is a standard deviation information ratio. So whenever the drifting mix is basically you don't do anything. So if you don't do anything about your equity and bond mix, then basically you will have higher standard deviation and lower information ratio. Do you know what is information ratio? Can I explain? No. Yeah. So the information ratio is one of the most important indicator of about the performance of any portfolio or mutual funds. So when you want to buy, suppose you want to buy mutual fund from Fidelity or like Mid-Asset, for example, then the first number you may want to check is actually information ratio. The formula of information ratio is like this. So RP is return of your portfolio, okay, and then RPM is return of the benchmark. So basically, information ratio measures how much does your portfolio beat the benchmark. Of course, we need a normalization. So when we normalize it, we want to normalize it with standard deviation of RP minus RPM. So if you invest in US stock market, the benchmark is likely to be the NYSE composite index, something like that. If you want to invest large funds in South Korea, then benchmark the mutual fund in South Korea, then the benchmark is likely to be KOSPI 200 or KOSPI composite index. If you want to invest in global portfolio, right? That can invest anything in the world, then the benchmark is likely to be MSCI World. Okay. So basically, we want to measure information ratio measures how much does your portfolio beat the benchmark at what risk. Okay. So in order to boost up the information ratio, skilled portfolio of course want to beat the benchmark, and in addition they want to follow benchmark very well. So the best thing is that they want to follow benchmark very well, but beat the benchmark by constant amount every period. Then this number can be very high. So the best performance would be like benchmark plus 3%, something like that. But that is usually not possible. Any question? So it is information ratio. So this is, so if we do the drifting mix, the information ratio is much lower than the other rebalancing. That's another example. So suppose there are two asset classes, equity and bonds, and annualized equity return is about 12% and standard deviation 15%, and return risk ratio is a ratio between this and this is 0.8 almost. And equity allocation is 100%, and bonds, it is annual return is about 8%, something like that. And equity, since it is bond, equity allocation is 0. And the drifting mix, if we do a monthly, if we don't do anything, so it is drifting mix, then the portfolio of the performance of the portfolio with drifting mix would be annualized return about 10%, 7-9%, standard deviation 11%, return risk ratio 0.96, and in the end, equity will occupy like 74.5%, and on average is 60%. So even though it starts with 50%, 50 and 50, half and half of equity and bonds, eventually equity is likely to dominate. On the other hand, if we do the rebalancing like monthly, quarterly, annually, or to the range or to the benchmark, their annualized return is maybe slightly lower than drifting mix, but standard deviation is also lower. And then standard deviation is much lower, such that return risk ratio is even higher than drifting mix. And then on average, this rebalanced portfolio has close to 50% equity and 50% of the bonds. It is another example. It is global asset class, global asset allocation. So it is global equity. Now we compare global equity and global bond. If we don't do anything, again, the information return risk ratio is 1.11, and equity, even in global portfolio, even for global portfolio, equity is likely to dominate the portfolio in the long run. So we need rebalance. If we do the rebalancing, then their information ratio, it's not exactly information ratio, it is information ratio if benchmark is 0, of course. The return risk ratio is much higher than, actually not much higher, but higher than, return risk ratio is higher than drifting mix, and the portion of equity and bonds is close to 50%. Okay. So in conclusion, rebalancing is important to control risk and to maintain diversification. Okay. So if you are a portfolio manager, you have to trade sometimes if you want to enjoy diversification. Okay. So any question about rebalancing? Okay, so again, the bottom line is that you need to do the rebalancing to enjoy diversification benefit. Now, next question is, why do we need diversification benefit? Why diversification is good? 강주연, what is diversification? Yeah, what is portfolio diversification? Now, Begum, could you please speak up? Okay, if you can go. Okay, then speak up. Okay.
Invest only one thing and diversify.
Okay, so why do you want to do the diversification, or why don't?
I can reduce the risk.
You can reduce the risk. So what do you mean by risk? loss of the money. So by diversification, you can reduce your loss. And you wanna add why? Okay, Wouter.
Yeah, if you only invest in one fund and the fund makes a large profit, that's a positive thing. But if the fund makes a loss, the loss will be only within that portfolio, that one stock.
Okay.
And if you spread that up into the diversification in markets, then the one loss will not overcome the profits of the other.
So basically, you have similar argument with Julian and what reducing risk, and especially about fluctuation. Okay. So
Is that related with risk aversion?
I'll go to that. Okay. I'll go to the risk aversion. So yes. So if you do the diversification in order to reduce the risk, it means that you hate risk, right? So if you love risk also, and if your argument is right, you shouldn't do the diversification, right? I'll go back to that point later on, but anyone want to add comment or thought about diversification? Why we do the diversification?
There's two kinds of risk. One is systematic, which is unavoidable. For example, earthquake in Japan is kind of natural disaster is not avoidable. But by diversification, there is some kind of risk which can be eliminated, and I think that's why we should do some diversification.
Okay. That's a good point. In risk, in finance, when we say risk, there are, roughly speaking, two types of risk. One is systematic risk. Another one is idiosyncratic risk. And usually diversification reduce or remove idiosyncratic risk. How about systematic risk? Systematic risk means the risk that affects all the portfolio. Idiosyncratic risk means the risk that affect only individual assets. Right? Therefore, if you have a lot of assets in your portfolio, then risk in one asset is maybe not important because you have a lot of other things. And the idiosyncratic part will cancel away. But about systematic part, since systematic part affects all the assets in the portfolio, therefore even if you have a lot of assets in your portfolio, it doesn't remove systematic part. But there is a way to reduce or eliminate systematic risk. How?
Insurance.
Insurance. Actually, every financial contract is insurance in some sense. So anything else? So it is right, but it's too general argument. Anything else? So basically, it's called hedging. Okay, you can eliminate systematic risk through hedging. Okay. Anyway. We'll discuss it later. Let's think more about diversification. Okay. Because diversification seems very easy topic, and everyone think he or she knows about diversification, but actually that's not true. I'll go to that argument one by one. Okay. I'll go deeply about diversification. So first, okay. Diversification increases compound return by dampening return volatility. The relation between compound return and volatility can be seen in the following example. So we have a very important argument here. It says that diversification clearly reduces risk, but it says that diversification also increases return. How is it possible? So suppose there are two portfolios. So year one, it produces 0. Year 2, its return is 0. So 2-year total return is 0. So average return is 0. About portfolio 2, now it generates minus 50% at year 1. Its return is 50% at year 2. But 2-year total return is now minus 25. And average return is still 0. So yeah, it is minus 50% growth, so 0.5 multiplied by 1.5, right? So it is, let me write it down. So basically, we have a minus 50%, so we have 0.5. And at the second period, we have 50% positive return, so we have this one. So it is, right? So which is basically minus 25% return. Right? So if we take a look at this example, they have same average return, right? But one portfolio generates 0 and the other portfolio generates minus 25%. So basically the two portfolios have the exactly same average return, which is 0, but portfolio 2 has a lower compound return, right? You all know compound return, right? Low compound return because of its return variability, right? So it means that if we can reduce the variability of a portfolio, basically we can increase the total return, right? For given average, for the same average return, if we can reduce the variability of the portfolio, we can not only reduce the risk, but we can also increase return as well, right? So that's the one source of diversification. Diversification basically reduce variability, and by reducing variability, given same average return, we can expect a higher total return. So that's the very important source of the diversification. And the difference between these two is called the diversification return. Return contributed to the diversification. So remember, diversification can not only reduce risk, but it increases return. It increases compound return given the same average estimate return. Any question? So let's go to even more practical example. So compound return from 1941 to 1990. With it. Okay. Okay. Please turn off your cell phone. From 1941 to 1990. So portfolio way, suppose we have two asset classes. One is S&P 500 and another one is a 20-year treasury bond. And suppose we have 50% and 50% of portfolio weight, and average monthly return of S&P 500 is like 1.03%. And average monthly return for the treasury bond, long-term treasury bond, is about 0.39%. And so it is a portfolio with 50% and 50%, therefore average monthly return is 0.71. Right? And the standard deviation is stock is about 4% and treasury bond is 2.4%. Their standard deviation. And portfolio standard deviation is 2.62. Okay. Any question until now? And then the compound return of the portfolio. So portfolio composed of half equity and half stock that generate 8% return. It is now annualized. It is monthly. Now we have annualized. So annualized portfolio performance with half and half stock and equity. No, stock and bond is about 8.11%. Now we can go one by one for each asset. Compound return of each asset. The compound return of each asset is for equity is basically about 11. So roughly speaking, it is like 10 times. It is continuous compounding. So it is continuously compounding. So it is slightly smaller than 20 times of the return. Okay? So it's about 11.1. And 20-year treasury bond is a 4% rate. And if you take the average of these two continuously compounded return of each asset, it is 7.84. which is smaller than 8%11, of the which is continuously compounded return of the portfolio. Right? So by constructing diversified portfolio, we have return higher than simple portfolio weight, weighted average of these two, weighted average computed with portfolio weight, right? The difference between this and this is because of the diversification. Okay. And we can analyze this diversification return further. So return due to diversification is actually, so it is a contribution of individual asset to the diversification. I'll let you know how we can calculate this part, return due to diversification. So return due to diversification for equity is about 0.5%. And the return due to diversification of a bond is about 0.0, so it is 8 basis points. So if we add them, it is 0.28. And if we add this return due to diversification and this one, that equal to our portfolio rate. Right? So basically, the difference between the two is 0.28, which is due to diversification. And each asset contributes to the diversification by this amount. Of course, portfolio weight is half and half, so we have to multiply 0.5 here and 0.5 here, and then it becomes this number, 0.28. Any question until now? No, it's too easy, right? It is a simple plus and minus, right? Until now it is plus and minus. So, please stop me if you have a question, okay? So, okay. The increment of the return contribution of an asset over its compound return, okay? So, the incremental return contribution is actually this part, contribution due to diversification, okay? Depends on how much the asset's risk is reduced through diversification, okay? So in this case, the increment is higher for S&P 500. Remember, S&P 500 is 0.48 and bond is 0.08. So if you multiply portfolio weight, it is 0.24 and it's 0.04, right? So this is much higher. Contribution of a stock part is much higher because more of its risk is diversified away. Through diversification, its risk is more likely diversified away. Therefore, conversely, from a portfolio perspective, judging assets in terms of their compound return penalize most those assets that benefit most from diversification, right? So, I mean, remember, they have a larger benefit because it has a higher volatility, and through diversification, we can reduce the variability of this individual asset. Therefore, we can generate higher diversification return, higher contribution from diversification, which means that simply judging each asset based on this individual performance is maybe not enough. Right? If we evaluate individual assets through this past performance, maybe we ignore how much they contribute to our portfolio through diversification. Right? This is exactly true here. So if we judge the individual asset, stock and bond by past performance, even though they make this large contribution, we only think this stock part contributes this amount, which is smaller than much smaller than this. In this case, they are quite similar, right? So again, judging assets in terms of their compound return penalize most those assets that benefit most from diversification. Okay. Now we can investigate in more mathematical way. So the compound return on asset I is well approximated as follows, using Taylor expansion. Okay. Now Taylor expansion, you should know Taylor expansion in finance. Could you please raise your hand if you it is your first time to hear about this thing, Taylor expansion, a lot, okay? Okay, Taylor expansion. So again, when we have question, okay, we have do the Google search. Taylor expansion, okay, or Taylor series expansion, okay, Taylor series, Taylor expansion. There are other resources. So Taylor series expansion, okay. So in mathematics, the Taylor series is a representation of function as an infinite sum of terms of calculated from the value of its derivative, blah blah blah. Okay. Yeah. So this is the definition of a Taylor expansion. Okay. For given function f(x), okay, for Taylor series of real or component function f(x) that is infinitely differentiable in a neighborhood of real or complex number a. So basically, we approximate Taylor series expansion says that we can approximate f(x) like this, which means that for a given function f(x), we approximate that function with x constant x square, x third square. So basically we approximate, we want to span of a given function with x square, x third square, and fourth square, something like that. We approximate a function with polynomial. So that's the Taylor expansion. This is very easy, right? So all you need to do is just differentiation. Differentiation once, twice, and 3 times. It is Taylor expansion. The general formula for Taylor expansion is like this. So you basically reach the infinity from 0 to infinity like this way. In finance we use Taylor expansion a lot. Unfortunately, actually, we ignore the part after 3. So we don't care this part. In finance, we do the approximation. We use Taylor expansion only up to this part. That is good news, right? So actually, we can do some practice of the Taylor series expansion. Actually, instead of doing myself, I want you to do the Taylor expansion for exercise. Okay. Okay. 오다해. Could you please do the Taylor expansion of this one? Just come and I'll show you the formula. Okay. So there is a formula, and just use this formula to do the Taylor expansion. Okay. Yeah. Please. Yeah. Why? What? Which part you cannot understand here? All of them. Let's assume A is 0. Okay, let's assume A is 0. So please do the Taylor expansion and set A equals 0 and do the Taylor expansion. And all you have to do is differentiation. So please. Anyway, please come. Yes, and then anyway, please try. First, what you have to do, go to the formula, and let's assume A is 0. So what is F0?
What is F0?
Okay, first write down that formula on the blackboard. Yeah. And let A is 0, so you can just put 0 there.
A
is zero.
zero.
No, A is 0, not FA is 0.
Okay.
Okay. Assume A is 0 and write down the formula. Yeah, so A is 0, so F 0, right?
Yes.
Yeah, you get 0. So write down that formula over the Wikipedia. Yes, that one.
Like this?
Yes, you are doing very well. Okay.
Oh, thank you.
Yeah, but A, yeah. So since it is 0, you don't have to write that part anymore, right? So yeah, just write down X. And this is actually, you don't have to write down Fx. Right?
Here?
Equal, okay, F0, then keep going on. So it is
keep
just
going
X.
on?
Yeah.
Isn't
This is
that
X.
all?
And what is the next term?
Right?
Yeah, but still A is 0. Don't
Oh,
forget that.
yes, okay.
Yes, and write the third term. Yeah. Yes, and keep going. And now, no, that's enough. And then, no. Now next, you have to plug. No, this is fx. So plug this exponential function to this one.
No, I can't.
So what is f0? Okay.
F0?
Yeah. What is f when fx is exponential of x? What is f0? So okay, we have to calculate what is f0. When fx is
Go back to 6.
no,
Okay.
so we have to do this one.
Oh,
So what is this?
F0?
Yeah, so you have to calculate this one and this one and this one. What are they? So differentiation, you have to do the differentiation of expression x. You are doing very well. So what is fx, f prime x actually?
No, I didn't run about that.
Oh, you didn't learn. Okay, you can go back to your seat. Yes, maybe you didn't learn this before, but actually we learned this one last class. Okay, when f is ex, what? What is f prime x? Yeah,
Yes.
it's the same, right? It's the same. Then what is f?
Same.
Okay, it's the same, right? Since f prime x is the same to the previous, so it is almost the definition of exponential function. If you do the derivative of a function, then it generates itself, right? That's the exponential function. So for how many times you do the differentiation, you have the same ex, right? So it is still e0 and this is e0, so it is 1, right? So to plug that one here, so it is what? It is 1 plus 1 factorial over 1 x plus 2 factorial over 1 x squared and then 3 factorial over 1 x3, right? And 1 factorial is basically 1, right? Therefore, exponential function is simply 1 plus x plus so it is a very convenient form. Very easy, right? Yeah, in finance, actually, we care only up to this part usually. We ignore many parts. Okay, I want to torture another student. Okay, now slightly more complicated. Okay, Taylor expansion. Any volunteer? Raise hand. You just raised your hand, so please. Yes, indeed. Use this formula and do the Taylor expansion and x is 0. Okay, when a is 0. Yeah, do the Taylor expansion at a 0. No, it is just x, not sin.
fx when x
Yes,
is
fx.
sin x.
Yeah, basically follow, which means that you are the approximate that sin x function with this polynomial.
Then how could I put the sin x?
Sin x is so over here. So you gotta do the Taylor expansion of sin x equals to
Equals to this.
yeah, it's so simply this is x. So this is x minus a, but since a is 0, so yeah. So plus it. Yes, right. Okay, and then that's right, and then you have to calculate these things. Right? What's are they? So fx is sine 0, right? So when fx is sine 0, if you want to calculate, yeah, x0. Actually, x0.
X is sin 0.
Yes, exactly.
What is sin 0? It's 1 or
Yes, so sine function looks like.
is 1 or less?
Yes, so sine function looks like this, right?
In this
Like this,
area.
and this is 0, and this is plus 1,
1.
this is minus 1, and this is pi over 2,
Oh,
this is
yeah.
pi, and this is right, something like that. So what is sine 0? Sine 0 is 0.
It's 0.
Okay, so it's 0. So what is different, if you take differentiation of sine x, what we have? Okay, so we have to know this one, right? What is this? So, do anyone knows if we take differentiation of sine function, what we have? What?
1 over cosine, right?
So it is actually minus
What is it? Minus.
minus cosine of x.
Yeah, how is
So again, let's write it down. So sine x, we take differentiation. Maybe I'm wrong, so if I'm wrong, please let me know.
Just cosine.
Yeah?
I think it's just cosine.
Oh yeah, it's just cosine.
cosine?
Sorry, it's cosine x. And if we take differentiation of cosine function, what do we have?
It's minus sign.
Yeah, this is minus sin x. Right? So we have this one, right? Now we have multiple differentiation of sine and cosine function. So why don't you do this one? Yeah.
What about f?
Yeah, so if we do the differentiation again, so sine x, if we do the one time, it is cosine x.
Cosine
So
x, like
one
it
second
is
time is this one. So it is minus sine x.
minus sin x.
Right. Yes.
Minus sin x. Is it right?
Yes, I think that's right.
And
So maybe it's
plus.
no, no, no.
Oh yeah. Oh.
Yeah, so yeah, a is 0.
Oh, there is.
Yeah, so x is over there, and you want to take f prime 0. Right? So what is f prime 0? So you put 0 over here, so you want to put it. So then f prime is this cosine function. So cosine 0 is 1. Right? So this is 1, right?
Yes.
And this is second prime, so it is 0. And this is minus 1, right? So
Cosine x is 0. Is 1 or 0?
so it is cosine, right? Differential sine is cosine function, and cosine 0 is 1.
Oh, cosine
Right?
1.
Yeah.
X.
And x is still there. Okay?
Yeah.
X is just x, right? I didn't give you value x, so we want to approximate sine x function with polynomial, so that is just x.
Just x
Exactly.
plus thing 0 as 0. 0.
Yes.
And cosine. Oh. Right?
Yes.
X.
And you don't forget 3 factorial.
3. Is it 1?
Yes, right.
Oh.
That's exactly. Okay. Good job. Yeah.
Okay.
Yeah, thank you. Yeah.
Got a lot because it was 5 years ago.
Yeah. Only 5 years ago. Calculus. When we do that Brownian motion or continuous time finite and everything, basically we do the Taylor extension.
I mean, how is it related to our diversification? Do we use it for compound return?
Yes, and I'm about to show. So, okay. Now we are all expert in the Taylor series expansion, and we want to apply the Taylor series approximation to the compound return. Okay. Well, compound return, which is continuously, actually when you say compound return, it is usually continuously compounded return. Okay. We want to approximate continuous compound return of log. So this is some random variable, right? Random variable. Okay. Let's call this is C. Right? So there, basically it means that exponential of the C is basically 1 plus R, some random value, right? So C is basically, so it is a per period return, right? 1 plus R. So let's say it is per period return discrete notation, and exponential of C is basically C is effective interest rate per period at continuous compounding, right? So basically, we wanna get an approximation of this part of C, right? So it is, so suppose we are considering annual return. So it is annual return. So it generates some R% per year. So it is discrete annual compounding, but maybe we wanna consider continuous compounding. So continuous version of the annual return is actually this one, right? Yeah. Again, to go to the previous example. So basically, if it is just one time, okay, it's one time compounding, and two time compounding is basically this one, right? So it is a effective this R is effective interest rate for two compounding, right? Two times of compounding, and if we do the n times of compounding, then this R is effective rate for n time compounding. Right? Effective rate for this R, this random variable. And if we do this one, keep doing this one, then basically we R, which is 1 plus R prime. Right? So this R is basically continuous compounded return, annualized. Okay, and basically we want to approximate this one. Let's say this is C. Okay, so this C is basically looks like this. Okay, and we wanna do the approximation of this one, this function. Okay, this function at around. So we want to do Taylor expansion of this log function around. So you can regard this whole thing as x. So basically, we want to do Taylor expansion of this function at its expectation value, right? Actually, we can do the one by one. So this is log x. We want to do the, so fx is log x, right? And we want to do the Taylor expansion around when x is mu. Okay, mu is basically expectation of x. Okay. So first, f prime x. Okay, f prime x. What is f prime x? When we take log, differentiate, when we differentiate log function, we have 1 over x, which is second right, and then okay, we don't need the third part. In finance, we usually ignore the third order. So let's do the Taylor expansion. So basically, log mu so f prime mu, so right? Then we ignore third one. Any question? So I'm very inefficient using the space in the blackboard. Okay. And then if we write it down, which means that rho equal, okay. So this is one. Which is negative, okay? Because it's negative there. Okay, we have something like this, right? So here, the x is simply x. Right? Any questions now? So it is just application of the formula. Any question? No, right? It's too easy, right? Because we are now all know what Taylor expansion is. Okay. And then, okay, this is just Taylor expansion of the second order, and we want to take expected value of this, right? We want to approximate expected value, so we put big expectation over here. And we put big expectation over entire other things, right? So we put expectation here, and we put expectation over here, and then we put minus expectation over here, right? Big. Okay. And then what we have? First part is simply, it is simply constant, right? So if we take expected value of the constant, we have the still constant, right? So it is simply rho 1 plus expectation of r. And about second part, what is the value of this one when you take expectation? Nina, what is the value of this part? Really? Okay. Okay. So this first part is a constant, right? So we can put this outside. Okay. Then we have only second part. So what is the expectation of r minus expectation of r? Nina, what is this? So if you take expectation, then expectation is basically linear operator. So it can go inside of the plus minus. Right? So it is expectation of r minus expectation of the r. Right? And this is expectation of r. And what is expectation of r? Yeah, because this part is the constant, right? The expectation of r is the expectation of r is 0. So this second term is 0. Right? So this second term is 0. What is this third term? Right? So this third term is, again, we can put this constant term outside. Actually, this whole thing. And over expectation of r minus expectation of r squared. Okay. So what is this? What do we call this part?
Variance.
A is variance, right? It's definition of the variance. So this third part is the variation of this r. So that's how we drive this equation. So compound return, when continuous compounding return, which is we call it C pronoun, it is basically approximated as like this one, right? So I'll link this equation with the previous, right? If we have lower variance, so S is the variance over here. If we can somehow reduce the variance, if we can reduce variance, which means that we can increase this C, right? It is minus sign over here, right? And diversification means by diversification, basically we can reduce this part. So basically, which means that we can increase this part. So it is a basic idea how diversification create value in the portfolio. Let's call it a day at this point, and then I'll resume next week from this point. Okay. Any question until now? No. Okay, see you next week, and please don't forget to homework.